Most investors, they worry about market swings, right? Losing money when things get chaotic. But looking through the sources we pulled for you this week, it seems like there's a much darker threat. Losing it all. Not to the market, but to the person you actually hired to manage your money.
Yeah, that's spot on. That trust you place in someone, that's the biggest vulnerability. So our mission in this deep dive is pretty straightforward. We're going to unpack your sources on financial fraud. Specifically, we're looking at Ponzi schemes, pyramid schemes, the whole blueprint, the goal, to give you some solid, actionable defense strategies, really help you Ponzi-proof your investments, secure that retirement.
And you can't talk about this without starting with Bernie Madoff. The name is just synonymous with this kind of fraud. The FBI called it history's biggest financial crime. What always gets me is how exclusive his firm was. People were begging him to take their money.
Exactly. He didn't need flashy ads. He used scarcity. That and the illusion of these incredibly steady, frankly impossible returns. They all came crashing down in December 2008, didn't it?
It did, a massive collapse.
It's the ultimate warning sign, really. Here's this major figure in New York finance, seemed totally legitimate, regulated even, handling billions, and yet he operated this massive fraud for decades, completely unchecked. It just shows you have to approach every single opportunity with, well, a healthy dose of skepticism. Maybe even profound skepticism.
So Madoff proved the real danger isn't necessarily the market volatility we all see. It's believing in something that sounds too good to be true, like guaranteed steady success month after month.
Precisely. That illusion is the hook.
Okay, let's get into the mechanics. How do these things actually work? Starting with the classic Ponzi scheme, named after Charles Ponzi, right? Back in 1920.
That's the one. He managed to pull in, what was it, over $8 million from 30,000 people, all in about 7 months.
Incredible speed. And he promised to double their money in 90 days, claiming he used international postal reply coupons. Something totally obscure.
Exactly. Obscure, hard to verify. That's key. It creates this illusion of a secret, legitimate way to make huge profits. But fundamentally, a Ponzi scheme is just a fraudulent investment operation. There's no real investing going on. The returns promised to the early investors, they're paid only with the money coming in from later investors.
So it's just robbing Peter to pay Paul, essentially,
Yeah.
all controlled by the manager.
Completely. The manager controls everything, shuffling money around, new cash comes in, pays off old promises. But there's zero actual profit being generated from any underlying asset or business activity.
And looking at the sources, this isn't new. This model is running wild way before Ponzi. The 19th century saw some huge ones.
Oh, yeah. Ferdinand Ward in the 1880s, nearly $17 million back then. And it dragged down Ulysses S. Grant's reputation, too. Then there was William Miller. They called him 520%, around 1899.
520%. Seriously.
Yep. Promised 10% interest per week, pulled in about $1 million before collapsing. The pattern is always the same.
Yeah.
Absolutely insane returns, backed by some flimsy, hard-to-check story.
Okay, so that's the Ponzi structure. Centralized manager, fake investment, new money pays old investors.
How does that differ from a pyramid scheme? They often get lumped together.
That's a really important distinction. While both are frauds, the structure is different. A pyramid scheme is more decentralized, and its main focus is outward. It's all about recruitment.
Recruitment. Okay. So instead of pretending to manage investments, they're focused on getting more people in.
Exactly. Think multi-level marketing or MLM. Structure's gone bad. Though not all MLMs are illegal pyramids, the illegal ones focus almost entirely on recruitment. You often have to pay a fee to join, maybe buy some product. But the real money, the commissions, they come primarily from signing up new members below you, not from actually selling the product to end consumers.
Right. So the money flows up from the newest people at the bottom, paying the people higher up the pyramid.
That's the core mechanism. If the main way to profit is just recruiting others and there's pressure to buy inventory or pay fees, that's a massive red flag for a pyramid scheme. So the Ponzi is about fake returns from a central manager. The pyramid is about fake opportunities based on recruitment.
You got it. Although, sometimes the lines blur. A Ponzi operator might use pyramid-like recruitment tactics to get cash flowing quickly, especially if they're desperate. They might frame it as an exclusive club you recruit your friends into.
It seems like the basic tricks are old then. But how are fraudsters pulling this off today? They're not talking about postal coupons anymore, are they?
No, definitely not. Today's playbook is all about exploiting complexity. They hide in plain sight using trendy industries or areas with weak regulation. It looks legitimate on the surface. We saw three major categories really stand out in your sources, all using jargon and complexity to confuse investors.
All right, let's unpack those. What's the first one? You mentioned green energy earlier.
Yeah, that falls under commodities and tax credits. The DC solar case is a perfect, if tragic, example, a billion-dollar fraud. They claimed they were selling mobile solar generator units. Big appeal, right? Green energy plus significant tax credits for investors.
Sounds great on paper. Tax deductions are always tempting.
Exactly. But the problem was they sold thousands of these units, about 9,000, that just didn't exist. They were completely fabricated. So new investor money, attracted by those juicy tax credits, was just used to pay fake lease payments back to earlier investors. Classic Ponzi setup, hidden behind green tech and IRS forms.
Wow. Hiding the fraud behind tax benefits. That's clever in a really insidious way.
It is. And you see the same pattern a lot with unregistered private placements. Things like direct investments in oil gas fields or non-publicly traded REITs. Because they aren't listed on public exchanges or fully registered, there's very little public information or oversight. It's a perfect breeding ground for fraud.
Okay, so complex commodities and tax schemes. What's the second category? You mentioned exotic assets, wine, crypto.
Yeah, the appeal here is often exclusivity or the promise of quick, massive gains in volatile markets people don't fully understand. There was that case of a British guy charged in a, $99 million fraud based on expensive wine collections.
Wine, how did that work?
He claimed the investments were secured by these valuable wine collections, but the wine didn't exist. Neither did the supposed loan brokers backing it. All smoke and mirrors.
But crypto seems like the Wild West right now for this stuff. The numbers are huge.
Absolutely soaring.
Right.
You saw the $577 million Estonian case, the $200 million Bitcoin scheme plea. Scammers prey on the hype, the FOMO, fear of missing out, and the fact that many people don't grasp the tech. They promise completely unrealistic returns, like 21% guaranteed on something as volatile as Bitcoin.
Guaranteed returns on crypto. That screams red flag right there.
It should. Your sources even brought up how initial coin offerings, ICOs, were sometimes described early on, basically as a kind of smart Ponzi scheme.
A smart Ponzi? How's that work in the crypto world?
Well, in some of those early ICOs, big holders, the so-called Bitcoin whales, would get in early on a new coin. They'd hype it up. Then they'd rely on a wave of retail investors, the greater idiots as the theory goes, to jump in, pushing the price up purely on enthusiasm. The whales would then cash out, leaving the later investors holding worthless tokens. The returns weren't from value, they were from the inflow of new money chasing hype.
That sounds disturbingly similar to Madoff, relying on constant new belief, new money. Okay, what's the third category? The one using regulatory complexity.
That would be insurance and false guarantees. A key example from your sources was the Next Level Notes scheme. Over $50 million raised. The promoter claimed investments were in precious metals, but also in Affordable Care Act, or ACA policies.
Wait, ACA policies? Like health insurance, how can you trade those like investments?
You can't. And that's precisely the point. It sounded novel, complex, maybe government-backed.
Yeah.
It made it really hard for an average person to check or understand that, no, you absolutely cannot trade ACA policies like securities. To make it seem real, the promoters sent out forged surety bonds, fake insurance documents, total fabrication.
And the kicker.
The kicker is this promoter had already been barred for life by FINRA, the financial industry regulator. Didn't stop him. He just rebranded and kept going.
Wow. That just underscores that the system doesn't always catch these guys. You, the investor, have to be your own first line of defense. And the scale is just mind-boggling. DC Solar's $1 billion, that $140 million First Liberty fraud down in Georgia, it's constant.
It really is. And to build that defense, you have to understand the psychology. Fraudsters aren't selling investments, they're selling emotion. They play on your hope, your excitement, maybe your fear of missing out. They want you to act fast, bypass your rational brain.
Right. The sources laid out that psychological playbook. What are those key emotional triggers they use?
It often starts with phantom riches. They dangle this prospect of incredible wealth fast, using buzzwords like risk-free, guaranteed returns, impossible promises. Then they layer on scarcity. This is a limited time opportunity, or it's super exclusive. They might even tell you not to tell anyone else, keep the secret.
That scarcity trick worked wonders for Madoff, right? Making people feel lucky just to be included. What about trust?
Crucial. They manipulate trust using source credibility and social consensus. Source credibility is faking authority. Fancy car, the corner office, maybe some fake degrees on the wall. It creates a shortcut to trust, so you don't dig deeper.
And social consensus, that's using the group.
Exactly. Targeting affinity groups is common. Churches, community groups, professional networks, they'll say, look, lots of people you know and trust are already in on this. It lowers your guard because you trust your peers.
It's pure manipulation. Okay, let's translate these emotional plays into solid investment red flags. What are the absolute must-knows? The big four.
Regulators like NASA and FINRA hammer these home. Number one, the most obvious. Guaranteed high returns with little or no risk. If it sounds too good to be true,
Yeah.
it is. Number two, high-pressure sales tactics. Anyone rushing you saying you have to act now or you'll miss out. Big warning sign. Third, overly complex strategies. If the seller can't explain it clearly and simply or promises unusual success from something confusing, be very wary.
And the fourth, you said this was the single biggest threat and also the easiest to check.
That's right, unregistered products or unlicensed sellers. If the person selling the investment isn't properly licensed or the investment itself isn't registered with the SEC or your state regulator, run. It means there's virtually no oversight, no required disclosures, and very little recourse if things go wrong.
And your sources pointed to one incredibly practical defense, something that could have stopped Madoff much earlier, the custodian warning. Explain that. Why is it so vital?
This might be the single most important piece of practical advice. You must never, ever write a check payable directly to the investment advisor or their firm. Never. Your investment funds must always go to a qualified, independent, third-party custodian. Think of large, well-known brokerage firms or banks that hold assets. And the account must be registered in your name at that custodian. Madoff got away with it for so long because he was the custodian, essentially. He held the client money, generated the fake statements. There was no independent check.
So if someone tells you to make the check out to John Smith Advisory LLC instead of, say, Charles Schwab, FBO, your name, major alarm bells.
Massive, immediate walk-away alarm bells, absolutely. And one more internal threat we have to mention, simple investor greed. That temptation for huge, fast returns, especially in those unregistered private deals. Fraudsters count on that desire overriding your skepticism.
Okay, we know the scams, we know the red flags. Let's build the defense. What's the practical checklist? What can someone do right now to check out an opportunity?
Let's break it down. First, verify the professional. You need to check if the person giving you advice or selling the investment is licensed and if they have any disciplinary history. Use the free tools available. FINRA's BrokerCheck database is great for brokers. The SEC has the Investment Advisor Public Disclosure, or IAPD, website for investment advisors. You can also just call your state securities regulator. NASA's website can help you find their contact info.
And you mentioned checking if they're a fiduciary. Why is that specific designation important?
Being a fiduciary means they have a legal duty to put your financial interests first, ahead of their own commissions or interests. Fee-based advisors working for registered investment advisor firms, or RIAs, usually operate under this standard and will disclose it. Non-fiduciaries, like some brokers, might operate under a less strict suitability standard. Asking, are you a fiduciary, is a crucial first question.
Got it. Verify the person, check their fiduciary status. What about the investment itself? Verify the product.
Right, because unregistered products are the top threat. You need to check if the investment is registered. The main place to look is the SEC's EDGR database. It's a huge online library of official filings for public companies and registered offerings. If the investment isn't there, or your state regulator has no record of it being properly registered or exempted, that's a huge risk. It means minimal public information, minimal oversight.
And if they give you excuses like, oh, it's too new, or it's an exclusive private deal not listed anywhere.
Walk away immediately. Legitimacy comes with transparency and registration.
Okay, verification is key. But let's say the worst happens. You followed the steps, but you still suspect you've been scammed. What's the next move? Reporting seems critical.
Yes, report immediately and document absolutely everything. Start a file, gather the promoter's name, contact info, website, any marketing materials, keep all emails, texts, communication records, take screenshots, create a timeline of when you invested, how much, any payments received, get all your account statements, transaction records. If it's crypto, save those transaction hashes and wallet addresses.
Compile all the evidence. Then who do you report it to? You mentioned multiple agencies.
Yes, report widely because they handle different aspects. File complaints with the SEC and FINRA. They handle federal securities laws and broker regulations. Report to your state securities regulator via NASA. They handle state-level laws and licenses. The Federal Trade Commission, the FTC, deals with broader consumer fraud and deceptive practices. And crucially, Report the crime itself to the FBI's Internet Crime Complaint Center, known as IC3.
Filing with all of them maximizes the chances of action, whether it's regulatory enforcement, asset recovery, or criminal prosecution.
Exactly. It casts the widest possible net.
This has been incredibly insightful. It really drives home that knowledge, checking the facts, and maintaining a healthy skepticism are your best defenses. The scams keep changing their clothes, but the underlying fraud stays the same.
It does. And, looking at the bigger picture, your source has raised a really provocative final thought. It shifts from individual fraud to, well, systemic risk. The idea is that maybe the entire global financial system, or at least large parts of it, operates a bit like a giant systemic Ponzi scheme.
A systemic Ponzi? How so?
Well, think about typical diversified portfolios. Many are implicitly short volatility. What that means is they fundamentally rely on continued economic growth, low interest rates, low volatility, smooth sailing, basically. Much like Madoff needed constant new money to pay old investors, the system often needs continuous growth, new capital, new expansion, just to maintain existing asset values and pay expected returns.
But the sources suggest that smooth sailing might not be guaranteed. Things like demographic shifts, global debt, geopolitical instability, they point towards a potentially bumpy ride ahead.
Precisely. Relying solely on that smooth, uninterrupted growth might be a fragile assumption. So it raises this really interesting question for you, the investor. Instead of just diversifying, which might just mean spreading your bets across many things that all depend on that same short volatility assumption, how do you build an anti-fragile portfolio?
Anti-fragile, something that doesn't just survive shocks, but potentially benefits from them.
Exactly. Maybe that means exploring strategies that are long volatility, things that might act like portfolio insurance. They might slightly lower your average returns in calm markets, but they could significantly cushion the blow or even profit during sudden crises or market shocks. It's about building resilience for that potentially non-smooth ride.
Food for thought indeed. Building a portfolio not just for growth, but for resilience against the inevitable bumps in the road. Thank you for sharing that perspective. And thank you, our listeners, for joining us on this deep dive. Stay vigilant, stay informed, and stay safe out there.